Welcome back to the channel. Today I'm taking a closer look at the recent surge of the US dollar, which continues to strengthen amid underwhelming economic stimulus measures from China. We'll dive into how these developments are impacting global markets, currency exchanges, and what this means moving forward. So let's get started with the latest updates. In early Monday trades across Asia, the US dollar extended its gains, driven largely by China's latest economic moves. Over the weekend, China unveiled a stimulus package that markets had anticipated, but it didn't quite meet expectations. As a result, we saw some significant movements in currency pairs. The euro fell to $1.0922, while the British pound dropped to $1.3043. Interestingly, the dollar remained stable against the Japanese yen at 149.20. The dollar index, or DXY, which tracks the value of the US dollar against a basket of other major currencies, reached 103.10 on Monday, nearing its highest level since mid-August. This shows that the US dollar remains strong in the market as traders have scaled back expectations for any significant rate cuts by the Federal Reserve for the rest of 2024. China's recent weekend announcement detailed plans to significantly increase government debt issuance. This move aims to provide subsidies to low-income families, stimulate the struggling housing market, and bolster state bank capital. Although these measures are an attempt to revitalize China's economic growth, the market reaction has been lukewarm, with investors expecting more substantial stimulus to counteract the country's current slowdown. China's finance minister, Lan Feng, indicated that additional counter-cyclical measures will be introduced later this year, but specifics on the scale of fiscal stimulus have yet to be confirmed. The global market response to China's economic measures has been somewhat muted. Many expected stronger interventions to fuel growth, particularly in the housing sector. As it stands, the US dollar remains the favored currency, reflecting continued investor confidence in the US economy's resilience, especially when compared to China's slower recovery trajectory. The strength of the US dollar is also being supported by current Federal Reserve policies. Traders are now scaling back their expectations for major rate cuts during the remaining Fed meetings in 2024. High US Treasury yields continue to attract investors, contributing to the dollar's resilience in global markets. While China has introduced several measures to boost its economy, challenges persist, particularly in the housing market. This sector remains in turmoil despite the government's efforts, and it's holding back broader economic recovery. If the housing sector continues to drag, we could see even more cautious responses from investors toward China. In summary, the current dynamics between the US dollar's strength and China's underwhelming economic stimulus reflect broader trends in global markets. The US dollar continues to hold strong, backed by high yields and a resilient economy, while China's economy faces headwinds that could slow down its recovery. Moving forward, traders and investors should keep a close eye on any further announcements from the Federal Reserve and potential larger-scale interventions from China. If you found this analysis helpful, don't forget to hit the like button, subscribe, and turn on notifications so you never miss an update. For more insights on global market trends, check out our other videos.